The concept of life insurance has many applications: death benefit, retirement income, cash value growth, and even college or retirement savings. The duration for which a life policy is intended also varies. An individual who has small children may purchase a 10 or 20-year term policy to provide protection until the children have completed college. A young family may purchase a 30-year term policy to pay off the mortgage in the event of an untimely death. Individuals desiring to set aside supplemental retirement income may purchase an index universal life plan, which features cash value growth linked to the stock market, gains locked in, and tax-free access to the cash value. The presentation that follows is a discussion of a guaranteed universal life insurance plan, a life insurance policy which has a guaranteed level premium, pays a guaranteed death benefit to age 100 or beyond, and requires evidence of insurability only at policy issue. The value and merits of the guaranteed universal life plan are the focus of this presentation. Before we begin, let us first review three very basic assumptions that are key to understanding the life insurance rate structure. The older an individual is, the more likely he is to experience death, and therefore, the more expensive life insurance becomes. As we age, we are more likely to acquire health impairments such as weight gain, high blood pressure, diabetes, heart attack, high cholesterol, stroke, and cancer. Note that health impairments as seemingly insignificant as a 10-pound weight gain, a slight increase in cholesterol, or a small rise in blood pressure can send rates higher. When supplying evidence of insurability on a life insurance application, the more health impairments listed, the higher the premium and the greater the need for life insurance. In a hypothetical example, a healthy 45-year-old choosing to purchase a guaranteed universal life policy might expect to pay $1,700 per year for a $250,000 death benefit. With this policy, our client would be assured that his policy would remain in force and the premiums would never increase as long as the premiums were paid. Let's contrast the guaranteed universal plan policy with the purchase of a 10-year term policy. A healthy 45-year-old might expect to pay an approximate annual premium of $250 for a $250,000 10-year term policy. The premiums remain level for 10 years. At that time, the individual completes a new application and furnishes fresh evidence of insurability in order to receive a new 10-year term policy. The annual premium is now $580 and once again remains level for 10 years. The process repeats itself every 10 years until age 85, when the 10-year term is no longer available. It's important to note that every 10 years the client chose to complete a new application, take a new physical exam, and provide additional evidence of insurability. He does so to achieve the lowest possible premium, assuming, of course, that our client remained healthy and insurable. What would happen if the client chose not to provide new evidence of insurability after 10 years, or after any of the term periods? Quite simply, the rates would increase, and increase quickly. While the rate of increase will vary from company to company, a typical rate increase might look like this. A more likely scenario is this. As our client ages, he gradually acquires health impairments such as high blood pressure, weight gain, high cholesterol, diabetes, heart disease, stroke, or some form of cancer. It is a safe assumption that under this scenario, our client's premium would be higher, perhaps much higher. In the initial term period, the 10-year term policy is considerably less expensive than a guaranteed universal life plan. However, one's ability to provide evidence of good health is never a certainty. The new term rates may, in fact, be higher. At age 75, and certainly at age 85, the thought of saving a few dollars in the early years of the policy is less appealing, especially if the natural process of aging has introduced health impairments. At age 85, our term client is without coverage, while our universal life client has coverage beyond age 100. And remember, our guaranteed universal life client provided evidence of insurability only once at the time of issue. His rates remain level despite any health impairments he may acquire. We have prepared an illustration outlining what a guaranteed universal life plan can do for you. We look forward to discussing it with you.